You have asked us for advice about your new coffee van business. We will give you the best advice for the following. The legal requirements and importance for registering a business name. To be able to apply for a business name, you need to pay a fee that goes up to $39 a year or $92 for 3 years, but it must be registered for 3 years and constantly renewed. When you apply for a name for your business, it can't be identical or similar to existing businesses. For example, the famous Coca-Cola brand, you can't name your business Coca-Cola. If you don't want to trademark your business, you can use your full name for the business if there isn't a similar or identical existing business. For example, John Smith Bakery doesn't need to register for a business name because John Smith is your own unique name. The importance of a business name as it helps your customer find, identify, and connect with your business.
To be entitled to an Australian business number, you must be carrying on a business in Australia. This means that you must have undertaken business-like activities towards commencement of trading. To apply for an ABN, you must need to have a tax file number and the tax file number of any associates, for example, partners, directors, and trustees. The GST is a broad-based consumption tax of 10% on most goods and services sold or consumed in Australia. Since you are expected to make 80 grand in profits, you will need to register for GST. To register for GST, your business must have an ABN. An ABN is a unique 11-digit identifier issued by the Australian Business Register, which is operated by the Australian Taxation Office. To report your GST, you will have to lodge a business activity statement to the Australian Taxation Office.
Sole trader. The characteristics of a sole trader. A sole trader can only have one owner. This means only one person can hold responsibility or be personally liable for all debts of the business. The ability to raise capital is only the owner. However, as you are the sole owner, this means all the profits is given to you, the sole owner. The transfer of ownership is impossible as it only has one owner. This is also for the business for the continuity of existence terminates upon owner's death or departure. The separate accounting entity of sole trader as the business accounting records are kept separate from the owner's personal records, and the separate legal entity makes the owner legally liable for the actions of the business. Partnership. A partnership is between 2 to 20 owners, however it still makes the owner all accountable of liabilities and connects to personal or work-related assets that can be taken. The ability to raise funds are solely on the partners to raise capital. The distribution of profits is dependent on the partnership agreement between the owners. The transfer of ownership is possible if it is stated in the partnership agreement and if it is allowed. This is also the same for the continuity of existence if it is stated in the partnership agreement. It will not terminate after the partner's death and departure. The separate accounting entity that the accounting records are kept separate from the partner's personal records. The separate legal entity is still legally liable for the actions of the business. Small propriety company. A small propriety company can be defined as having between 1 to 50 non-employee owners as they are mostly shareholders. The liability of owners is not liable but only for the amount they paid on shares. The ability to raise capital is dependent on existing shareholders or employees and the general public if shares are public. The capital raising limit consolidate a revenue or income under 50 mil of assets under $25 million and have less than 100 employees in the company. The distribution of profits goes through multiple company directors to approve a certain cut distributed among the shareholders. The transfer of ownership is dependent on share transfers if allowed in the company's constitution. Also, the continuity is the same exact as a transfer of ownership as it is the same through transfers of shares if it is allowed in the company's constitution. A small propriety company is a separate accounting entity as the business accounting records are kept separate from other shareholders' personal records. It is a separate legal entity as shareholders are not liable of the actions of the business. However, the company can be used to set foot into contracts that can be under property and litigations.
We recommend you to have a partnership business since you want to avoid having to manage time, consuming, and expensive reporting requirements. In a business partnership, you will have to know these following things. For the distribution of profits, you and your partner will have to come up with an agreement that defines the share of all profits. In a partnership business, there is unlimited liability. This means that you and your partner are responsible for all company debts and all other financial commitments. If any partner cannot pay their debts, their personal belongings or property must be sold to pay for debts. The continuity of existence for a partnership is that the business will terminate upon a partner death or departure unless covered in an agreement.
Question 5. A lease is a legal agreement between an owner and the renter, in which the owner grants the renter the right to occupy a property, office space, or a vehicle for a specified period in exchange for payment of rent or a lease. A lease can be both short-term and long-term, depending on the contract or terms written in the agreement agreed by both sides. The lease agreement is legally binding, and a violation of the agreement can be a fine or a legal action. A short-term loan is a loan that only extends up to a year, but has to pay principal and interest. However, it is easy to obtain, much more faster than most loans. Examples of short-term loans are credit cards and bank overdrafts.
There are a number of variables that a financial institution would consider when deciding whether to grant financing in order to assess the borrower's credit worthiness. Here are 3 crucial elements that a financial institution would take into account before approving financing. Credit history. When determining whether a borrower will be able to repay a loan, financial institutions will take into account the borrower's credit history. They will examine the borrower's credit reports, which contains information about their credit history, including any late payments, defaults, or bankruptcies, as well as their credit score, which is a numerical assessment of the borrower's trustworthiness. The financial institution is more likely to grant the funding if the borrower has a solid credit history and score. Considering you have paid off a $160,000 mortgage and have an excellent credit rating, it means you have a history of responsible borrowing and payment, and that you have demonstrated the ability to manage a large debt over a long period of time.
Question 7. The source of finance that we would recommend you for your mobile coffee van is to lease it, as leasing fits your situation and would give you the most out of the other sources of finances. The advantage of a lease is that you haven't fully committed. As you said, this is your first time. If you don't make a margin of profit or you have second thoughts, you can always return the asset back to the leaser. Additionally, leases can be tax deductible by the government. The advantage can also be a disadvantage, as you don't fully own the van and would still be paying for the lease, and on top of that, if you have committed to your business, the full price of the van.
In conclusion, we think the information we provided you is optimal and hope you take it into consideration.